A lot of us here are in delta neutral high theta trading, right? So come in and we do directional trading, and maybe that doesn't work out for us because we don't understand the price movement. We don't understand risk reward ratios properly and how to control our structural risk and so forth, right? So that leads a lot of people from directional trading out into this positive theta trading. They say, hey, if I can maintain high theta and keep my delta really low, whereas, some people call it zero delta trading, then I'm trading time and I'm going to make all this money.
Before we get rolling here, just a reminder to please like and share our videos. Your support helps us to continue to bring you the wonderful content that we share with you each and every week.
Realize that, you may have zero delta when you enter, but your delta changes, right? Your position delta changes as things go along. Sometimes that delta changes drastically with price movement, right? So, and price is going to move, especially nowadays. Like back in 2006 and 2007, 2008, we got some good price movement. But, back in the days when this was kind of starting out for retail traders, price didn't move that much. Today, it moves a lot, right? And yes, we get more favorable implied volatility skew curves that allow flatter delta in our trades, but you still get like huge delta changes with our price movement, especially if you're high theta. So the higher theta you are, and we'll call it, because this is I hate to call it this, but I'll call it gamma risk because I hate to call it that because it's not really accurate. But that's the term that most people understand. And gamma is basically the rate at which delta changes in the next $1 of price movement. As price moves, that also changes drastically. But a high theta position is going to give you a lot of gamma. It's just that's what it does, right? That's the way the formula works. So the higher your theta, the more the delta is going to change with price movement. Also, another realization that a lot of people don't have, which is kind of surprising to me, but is that theta changes drastically with price movement. It's like people look at an analytical screen, they say, hey, I have this huge amount of theta. But they don't realize that if the price was somewhere else, right? In other words, hey, the market's going to be 100 points over here tomorrow. They have no theta there, right? So, ideally, if you really wanted to make money, or if you really want to take advantage of theta, you would try to take advantage of theta where the price is going, not where the price is now. Meaning, again, the theta on your analytical chart isn't particularly useful, or at least, where you're at a particular time. But because we get these price movements, it can be challenging to maintain a flat delta, right? It can be very challenging if we're getting these big moves, particularly if we're closer to expiration. Also, the current theta number anyway has very little relevance because, again, as the price moves, the theta number changes. In addition to that, the majority of your price gains or your P&L gains and your P&L losses in your position through time are much more influenced by implied volatility skew changes than they are to theta, right? So it's not like you go 3 days and your theta is 300 and you're going to make $300 a day. But you might make $900. You may make $100. You might lose $1,000, and the price may not move at all, right? And that's because your T+0 line doesn't shift according to theta, it shifts according to implied volatility skew curves. All right. So I think that we should make sure that we have that understanding. And the reason I'm pointing this out is because we have so many people who come in here and they're just doing things like that are going to give them problems by focusing so much on delta and theta. So focusing so much on trying to keep a flat delta and at the high theta number. So trying to make money through the concepts of maximizing theta and keeping delta flat. Is it possible? Yeah. And it's good so long as things go well, right? So it doesn't really matter. Any decent income trade that you have, it's going to have this win rate of like 60 to 80%. A lot of like the M3s and so forth, they run at like 75 to 80%. They're on the higher end of the range. Some of the other ones run a little bit lower. Very rarely are you over 80%. If you're over 80%, you have a crappy reward risk ratio. Or an extra crappy reward risk ratio, which we'll talk about later. Usually if you're at the 60% range, a lot of times you'll have a better reward risk ratio, but not necessarily. But this is these are gross generalities. Positive theta flat delta trading is generally riskier than most long directional trading approaches. Not all, right? So, I mean, you have some very risky long directional trading approaches. If I was going to take, on average, if I take a look at the directional trading approaches that we have in most of the assets, and then I look at and again, this depends on your strategy, but assuming you have a decent directional strategy, it's generally going to be less risky than a flat delta strategy. And again, that has to do with two things. So pretty much all of your flat delta data driven trades are going to have a poor average win to average loss ratio, right? So again, it doesn't mean you can't make money, but you're going to have generally it's not one to one, right? So a lot of times you'll have a profit target of say of we'll just call it $100, and you'll have an exit loss trigger of $100. So that's one to one profit target to exit loss trigger. But you often don't hit profit targets, so your average win's actually lower than that, right? And then a lot of times when you hit your loss numbers, or you're generally not going to be out at a loss number unless you hit your maximum loss. And a lot of times you'll exceed that number by 1.5 to sometimes 2 times. And that gives us, like, if you have a trading strategy that wins 10% with a 10% profit target, for example, and a 10% exit loss trigger, you're probably running average win of 4 to 5%, and you're probably running an average loss of 8 to 10%, right? So that dynamic itself means that you have to have a win rate in the 60% range in order to break even, sometimes in the 70, 75% range in order to break even. So we should be aware of that dynamic. It's very important. And then you have to also realize that this type of approach is very difficult to recover from drawdowns, both from intratrade drawdowns and from losses of trades. So in other words, if I get into a flat delta trade and my objective is to maintain a very tight delta range on that trade, and say I get a big down move in the market, that's usually the problematic direction for these types of trades because volatility sensitive and so forth. But let's say I get a big drawdown, I flatten my delta out. Now it's going to take me a long time to recover, and things have to go a certain way, right, in order for me to be able to recover, just to recover back to neutral from that position. So it happens a lot of the time, but it's a pain, it's a slow process, and so forth, right? It's also difficult to recover from the drawdown if I take a 2 times exit loss trigger loss on the trade. It's going to be challenging to recover that because my average win's only like 5%. So if I had a 10% and I take a 20% exit loss trigger or something close to that, it takes me 4 average winning trades to get back to break even. And if you're doing one trade a month, that could take a year, right? And then if you change your position size, it kills you, right? So in other words, if I take that loss and I get like freaked out about it, then I mentally can't deal with trading that size anymore. That's just telling you were trading too large in the first place. But if that happens, which happens very commonly, and you end up dropping size, now it's not going to take 4 trades, 4 average wins to get you back to normal. It's going to take maybe 6, maybe 8 if you cut your size in half. And by the time you won 8 times, you got an 80% win rate, it's time to lose again, right? So that dynamic is another thing that kills a lot of this type of trading. I can do that all day long with directional trading a lot of times, but I can't really do that with this type of trading. If I start dropping size because I'm going through a rough period, that's going to be very, very problematic for my overall returns. And the other thing with this general approach is adjustable approaches where I'm making adjustments are often pretty maintenance intensive, especially as we get closer to expiration and our theta starts to increase and our gamma starts to increase. And if we get a lot of price movement during that period of time, then we have a lot of challenge, a lot of maintenance or having to deal with the trade. And a lot of times you feel like you have to deal with the trade because you have so much money at risk. So it doesn't mean that you can't make money this way. You can. It's certainly great for like a novice who really has no understanding of price movement yet. It's a way that they can be successful in the market and do fairly well, assuming you're maintaining a consistent trade size and be able to be profitable. But it's certainly not the best way to do it. And if you're somebody who's looking for like outlandishly, high returns, and what's that? I mean, most fund managers don't beat the S&P 500, right? So they would consider like 20% a year pretty high returns. So if you're looking for like really high returns, then you just have to become better at trading. And that's possible. We can certainly do that, but you need to become better. So how do we get better? There are multiple ways. In the pro membership, we talk a lot about obviously price movement, right? So if you learn to understand price movement and normalcies in the marketplace, that is one area that you can greatly improve your trading results.